15 cities in California are unraveling, and the housing market shock here is not just chatter. It's a financial stress test in motion. Behind the sun and redwoods, a tangle of wildfire risk, insurance scarcity, sliding demand in some metros, and rising carrying costs is quietly reshaping whole neighborhoods. California didn't see a one-size-fits-all collapse, but the forces at work are forcing people and investors to rethink where they live and how much risk they'll carry. Public Policy Institute of California. More than a simple price correction, this is regional divergence. Some coastal and Bay Area markets are holding up or even hitting new highs, while inland and formerly red-hot exurbs are seeing sharp price cuts, inventory floods, and rising foreclosures. Net domestic outmigration that spiked during the pandemic has slowed, and international migration has partially offset losses. But the county-by-county story is messy, and certain cities are on the short list of places feeling the squeeze. Public Policy Institute of California. Why are Californians moving, downsizing, or walking away? The math. Median home prices that doubled in some markets during the pandemic now face pressure from higher mortgage rates, rising insurance costs, and larger carrying charges. When mortgage rates climbed from the 2 to 3% range in 2021 into the high 6s and 7s, monthly payments for the same loan amounts jumped by hundreds. And for many buyers, that extra monthly hit makes a purchase impossible. Legislative Analyst's Office. Insurance has become an existential problem for many homeowners. Wildfire exposure and catastrophic payouts pushed carriers to limit new business, seek large rate increases, or pull back in high-risk areas. Regulators and the Department of Insurance have been scrambling to stabilize the market. But Californians are still seeing big premium hikes and more reliance on last resort mechanisms, moves that can turn a mortgage-affordable home into an unaffordable burden almost overnight. California Department of Insurance. Inventory is piling up in the places where demand has cooled. Active listings and homes sitting longer are appearing across inland metros and parts of the Central Valley and Inland Empire, even while coastal and high-amenity areas remain tighter. That means sellers in many cities are cutting prices, sometimes dramatically, to generate offers. Fred. Four forces are rewriting California homeownership economics, and together they're creating pockets of intense stress that look, in tone, if not in exact numbers, like the Florida unraveling you described. The insurance squeeze. Years of megafires, inflation in construction costs, and catastrophic payouts forced many insurers to restrict underwriting or ask for steep rate increases. California's insurance regulator has approved increases and launched programs to expand coverage, but the results so far, higher bills for homeowners, limited availability in high-risk areas, and a growing burden for older owners on fixed incomes. In some wildfire-exposed zips, premiums have risen sharply enough to rival mortgage payments, changing the affordability calculus overnight. California Department of Insurance. The affordability squeeze. Wages haven't kept up with housing costs in many regions. Add insurance, property taxes, HOA dues, and potential special assessments, and monthly carrying costs balloon. For first-time buyers, the math is brutal. For retirees on fixed incomes, the choice can be pay the higher bills or sell and leave. The statewide median still sits far above national levels, making trade-offs inevitable. Redfin. Investor pullback. Institutional and small investors that once propped up markets, especially in short-term rental hotspots and fast-growth suburbs, have scaled back purchases. As yields compress and vacancy where regulatory risk rises, investor demand has dropped, removing a layer of support under prices in vulnerable markets. When investors sell to exit, Inventory swells and discounts accelerate. Redfin. The flood, or rather inventory problem. In multiple inland and ex-urban metros, active listings and homes sitting longer are appearing across inland metros and parts of the Central Valley and Inland Empire, even while coastal and high-amenity areas remain tighter. That means sellers in many cities are cutting prices, sometimes dramatically, to generate offers. Fred. Which cities are getting hit the hardest? The list looks different than Florida's coast, but the theme is similar. Places that saw fast pandemic-era growth or depend on investor demand are the most vulnerable. Examples of stressed markets and the pressures they're seeing include Stockton, Modesto, and Fresno. Rising price cut percentages, in some neighborhoods, heavy seller discounts, and elevated inventory as affordability retreats. Reventure News. Bakersfield and parts of the Central Valley, new construction slowdowns, incentive programs from builders, and longer days on market. Redfin. Riverside and parts of the Inland Empire, sharp price corrections in certain zip codes as commuting-dependent demand softens and mortgage-sensitive buyers step back. Reventure News. San Francisco and some Bay Area suburbs, a mixed story. Some neighborhoods show cooling or price declines after the pandemic boom, while other pockets remain resilient. High costs, remote work shifts, and investor recalibration have produced divergence within metros. Wolf Street. Santa Rosa, Sonoma County, and other fire-impacted communities, insurance stress, potential special assessments, and the specter of future wildfire events are weighing on values and sales dynamics. California Department of Insurance. Condo owners face their own version of the storm. California requires reserve studies and disclosure under the Davis-Sterling framework. Associations that discover deferred maintenance or structural needs are increasingly raising assessments or levying special charges, and buyers and lenders are demanding clear reserve funding and inspection records. That combination has made some older buildings harder to finance, shifting sales to cash buyers and lowering market liquidity in affected complexes. Davis-Sterling. Real examples and quick snapshots. Builders offering buy-downs and cash incentives in new subdivisions. Condo boards approving large special assessments after updated reserve studies. Homeowners being quoted much higher premiums or seeing fewer insurers writing new business in their area. All signs that carrying costs are being repriced into the market. Lenders are increasingly asking for reserve studies, structural reports, and proof of insurability before approving loans on complex or high-risk properties. FSR. What does this mean for buyers, sellers, and investors in California in 2025? The playbook is the same as it would be anywhere under stress, but the specifics matter here. Buyers, don't just look at the sticker price. Confirm full monthly carrying costs, mortgage, property tax, HOA fees, flood and wildfire coverage estimates, and any pending assessments. Get insurance quotes before you sign. Run worst-case cash flow scenarios if you're buying an income property. Legislative Analyst's Office. Sellers, expect buyers to ask for concessions, rate buy-downs, closing credits, or even a year of HOA dues. If you bought at the peak, be ready to face longer days on market and price adjustments. Document building reserves, inspection reports, and insurance history proactively for condo sales. Redfin. Investors, update assumptions. Rental yields are compressed in several formerly strong markets. Vacancy risk is rising in fringe suburbs, and insurance or regulatory changes for STRs or short-term platforms can flip your returns. Stress test portfolios for higher costs and longer exit times. Redfin. This isn't a single headline number like 275,000 leaving the state. California's story is more complicated. Domestic outflow rose during the pandemic but has slowed, and international arrivals have helped stabilize the total population. But local shocks, wildfires, insurance pullbacks, reserve assessments, and mortgage rate sensitivity are creating severe local pain in specific cities and sectors of the market. The result is patchwork, winners and losers across the state rather than a uniform crash. Public Policy Institute of California. If there's a single takeaway, it's this. California's housing market has not escaped the correctionary pressures felt nationwide. Higher mortgage rates, rising insurance costs, investor repricing, and increased inventory. But the state's unique climate risk and regulatory landscape mean the correction is asymmetric. In some cities, the boom has turned to gluts and deep discounts. In others, values remain stubbornly high. For anyone buying, selling, or owning, due diligence on costs and a forensic review of insurance, reserve studies, and local risk factors aren't optional. They are survival tools.